Hey guys, this is a market update. The Bitcoin halving is this month. It's a major event for Bitcoin. And this one is pretty special because this time the inflation rate for Bitcoin will drop in half to be underneath gold's inflation rate for the first time. We're going to look at halvings and Bitcoin cycles in this video and how all of this may play out. Why it's important is because right now we're coming into a halving. And as you can see here on the left-hand side, this is kind of day zero, right? So the halving day. In the 300 to 500 days after each previous halving, the Bitcoin price has completely exploded to the upside, obviously. And that's important because if that happens again, we're potentially, climbing up Mount Everest right now. And so obviously we need to pay attention to this. Now, I'm a long-term investor and I believe in Bitcoin, not just as a trade, but as really, the basis of the assets that you should be holding. So let's go through all of that in this video. Firstly, with the Bitcoin price right now it's April, I believe it's tax season, and so we may be getting some selling. A lot of people may be trying to pay their taxes, right? Because you can't sell 1/50th of your house to pay for your taxes, but liquid assets like Bitcoin may be liquidated to pay any potential taxes, especially as we're up 350% this year. We are just hanging out at all-time highs. It feels kind of surreal, to be honest, because the price is just lingering, pretty much above the peak in the last bull market, which was seen as a massive rise. And we're just here hanging out, right? Waiting for the halving, waiting for everything to kind of, get churned up and then potentially that big move to the upside. Is that going to happen again? Or, is Bitcoin just going to fail and not do this? There's a lot of data in this video that we'll look at. If you do trade though, Bybit deposit bonus down in the description up to $30,000. Click the link down there for the details. 3 or 4 months ago, I shared these charts with the crypto course members. So I'm going to share them publicly now as well. These are actually from Fidelity and it just shows us Bitcoin cycles and how it's maturing as an asset. So Bitcoin macro perspective, you can see these are the analogs of the previous halving cycles. So if we play out like previous halving cycles from this date, this is potentially where Bitcoin would go. So obviously we're not going to get up to $1 million per Bitcoin in this cycle, right? I just don't see that. As bullish as I am, it's not going to happen. Now obviously Bitcoin was younger back in these previous cycles, and so the percentage gain is obviously a lot more in these cycles than now, right? So the percentage that we're moving is a lot lower. However, the nominal dollar amounts that we're gaining is actually higher. In any case, you can see from here, we've actually come up to the all-time high now. So we're about here. So we're performing very well in relation to this cycle versus others, but a long way to go. This is the Bitcoin network in terms of its price growth versus the actual network growth. And this is non-zero addresses. Now, I think things are getting a bit weird at this point because Bitcoin, you can't just say a address is a user and that's it. We now know that the ETFs are, proliferating Bitcoin as an asset. So there are many new entrants into Bitcoin, but they're not creating new addresses. They're not using that blockchain specifically, right? The actual base layer is more of an international settlement layer. And yes, essentially what happens is you might get 50,000 new people that have now bought Bitcoin thanks to the ETFs, but essentially they are just wrapped up into one address because you have Grayscale selling to BlackRock and, over a day that just gets passed over. So it's kind of difficult to see the growth of Bitcoin because of all of the ways that we can bundle up BTC and then proliferate it to more people. You can see the non-zero addresses are growing, that they will grow, but it's more difficult to understand that growth. In any case, you can see Bitcoin non-zero addresses are following this network adoption, this kind of growth over time, and the price just matches that. So it's a network adoption valuation model. It's fairly simple. If Bitcoin continues to grow over the next 10, 15, 20 years, if that's your investment time horizon, the price does follow that. So I think it's fairly simple. These are demand models. So what you're looking at is the Bitcoin growth, the network growth versus essentially internet and mobile. And so right here, you can see that growth as well. So it's a network adoption model. Bitcoin is the network because it's money, right? Money is a network. And so it's just following very simply network adoption models that we've seen previously. So again, we don't know if this is going to happen. Like I said in the crypto course videos, the internet is a no-brainer for everyone because it's basically free to access. Yes, you do need a mobile, but the cost of those came down significantly, and you can buy them for family members or whatever. And so everyone wants to communicate with other people. And if you're given a phone and basically internet is, very, very low cost, then that's just a no-brainer for everyone. Far fewer people are going to adopt Bitcoin, in my opinion, because it's a risk. It's a risk asset, and there's potential downside and volatility that a lot of people don't want to get involved with. So I'm not sure if it's going to grow at this same pace. But the flip side of that is that many investment houses and ETFs are actually going to put this into investment portfolios. Even if people don't actually realize they hold it, they may actually still gain access to it. This month, when the Bitcoin halving takes place, the inflation rate of Bitcoin is going to drop to below the inflation rate of gold. You can just about see this. So the current inflation rate is about 1.7% according to this, 1.8% I had in my graph. And you can see the halving brings the inflation rate down. Overnight, it just halves. These are the halvings here. So the inflation rate actually just drops down, and then the halving goes down. And the price moves up after that for about 12 months or so, 18 months. Now there's a macro cycle in here as well, a debt refinancing cycle that also pushes the Bitcoin price around. But it's very clear to see that Bitcoin is entering a period where the inflation rate is so small that it actually gets dwarfed by demand, right? And so what we really need to ask is there going to be increased demand for Bitcoin over an investment time horizon, let's say the next 20 years? I think yes, and I've got some data to go over my reasoning here. Just before that as well, this is a really good chart. This is net unrealized profit and loss from CryptoCon here. So you can see Bitcoin cycles if we're looking at this cycle. We're maybe about halfway in this cycle. We have the halving, and then the second half is after the halving, maybe 12 to 18 months, something like that, right? This is the short-term, halving cycle mixed in with the debt refinancing cycle. And it looks like central banks are going into a period where they've done all their tightening and now they're just going to ease off a little bit. The extent to that is unpredictable, but also kind of irrelevant, right? It doesn't really matter the extent to which they ease or become softer. It just matters that they are a bit softer. And remember, Bitcoin has value only in relation to other things, right? So the environment is a little bit easier for risk assets. Well, which one of those risk assets has more growth than the others? Crypto, generally, right? So certainly Bitcoin. So you can see we've really come up here a lot into this area, which typically we do that before the real all-time high. So you have this green line, which is kind of the first recovery, right, into the bull market. But then you don't really top out until this red line, this cycle top line. And you can see on the NUPL, net unrealized profit and loss, it's a small move from green to red, right? This kind of last bull market move. But in terms of price, it's absolutely massive, right? So we had the all-time high here. We kind of got up to it, which is the green zone. And then this small move in net unrealized profit and loss is the big kind of blow off top into the bull market. That's what we would be typically looking for, is from wherever we are now, that real undeniable bull market where you just break through the all-time high and then you just get that price discovery for like 6 months of just huge green upwards moves. So is that going to come? I suspect so. We don't know when, we don't know the extent of it, but kind of irrelevant. So that move is actually something that long-term investors can look for, not just as a great trade if you're making money to the upside, but then to think about the next part of the cycle, which is actually the drawdown phase. We're getting into the area where this isn't really a good trade anymore. It's not really a good short-term trade because of, you can see here, we're about halfway through a bull move, right? So MVRV down here at 0 is a buy, right? You're buying that as a trade, right? Because the next 2 years would be MVRV moving up to the red zone, which is a sell if you're trading, right? As we're halfway now, the trade for this cycle is getting worse. Prices are moving up. The cycle is getting more mature. So as a trade, not really, it's actually looking worse and worse as a trade because obviously you're not going to be buying when you're in the red because you're looking for maybe the price to draw down then. So the trade is getting more mature. The profits for a short-term trade are getting less. So we have to be aware of, if we are buying here, we are long-term investors. And if you're buying up here when MVRV is 4 or 5, you'll definitely be a long-term investor, because unless you sell very, very quickly, you're going to get drawn down, and you're going to have to hold it then through to the next cycle. So short-term, we have one move left. We have one trade left, short-term, which is we've had the move from the lows to the previous high. Now we have that high to the new high. There's only one phase left. So we don't know how that's going to happen, the extent to which it's going to happen, the timing. But traders would be looking at this and saying, yeah, we still have that one move left, right? Never before have we come up to the previous all-time high and just like rejected down, because the network's growing, it's coming on. We now have ETFs, it's proliferating out, and so people are expecting that one extra move. So that's the trade. You've got one chance left for that trade if you want to go long. After that, you're looking at maybe the next phase, which would be another drawdown. But what's the long term here, right? Because like I said, if we're buying now, prices aren't that cheap. The trade was to buy at 15, 20, 25, 30 for that. We've still got that one phase left, but the risk reward is getting worse as we get more mature into a bull market, right? So let's have a look at the long-term reason for BTC. So this is GDP in the States since the 1950s, and we can see a very small downtrend here. But we know that the central bank wants GDP, 2.5%, right? But the problem is, what is GDP? Why do we look at GDP? And why is it completely fake as a metric, in my opinion? So 2.5% GDP, what does that mean? Well, let's have a look at the amount of debt being created in the economy, which is a stimulus. Debt creation stimulates the economy because it's being pumped into the economy, right? You create debt to pay for stuff. You pay for social security, you pay for all of the other stuff, military, everything else, which is a stimulus into the economy. So debt creation pumped into the economy creates a stimulus, creates GDP. Well, if you are creating more and more debt, and that's exponentially growing larger, but GDP is staying at 2%, that's a bit of an issue, right? So what you're saying is the actual economy is not growing in GDP terms, but you're creating more and more and more debt to keep GDP around the level that you say you want it at, which is around 2%. So federal debt held by public seems to be going up here. If we look at the amount of the US budget surplus deficits and major deficits, right? So what we're seeing is massive, huge debt creation, trillions of dollars of debt creation, getting worse and worse and worse. In blue, that is the actual projection of what's going to happen to debt. Now, all of these projections tend to not really be correct, but what we're seeing is huge amounts of debt creation since around 2000 or so, right? Lots of debt creation here, and that is going into the economy. So debt creation, we know that the central banks are printing money as well. So printing money, stimulus. What is printing money? It is stealing the value of your labor, debasing the purchasing power of your labor, and pumping it into just like the economy in general to keep everything up and keep inflation going. So more and more and more debt is being required to keep this GDP figure that they say is like accurate or something around 2%, right? This is $1 trillion, right? So you can see the amount of debt that's being created is trillions of dollars. We don't have a very good way of kind of thinking about exponential numbers, but that's a billion, and this is $1 trillion. So we're creating an essentially a exponential amount of fiat currency. You have your labor and your output, and these guys are literally printing trillions of dollars more units of currency that they're flooding into the economy, which is pushing all prices up. Why are they doing that? Why are they pushing all of these new units of currency into the economy to push prices up? This is actually what they need to do. They need to do this because the fiat currency system is debt-based, and all of the debt is issued on assets. But the problem with that is that assets actually should go down in price. So these are price changes of things in the economy. So what we can see is that technology should force prices down, actually, because technology is the invention of ways to get more units of output per each unit of input, right? That's why we invent spears and knives, because you use less energy to get what you want. Fire, energy, steam engines, oil and gas, combustion engines, jet engines, nuclear power, computing, right? So for anything that you want, you can get output for the least amount of energy input. Economies of scale, manufacturing, right? Tractors rather than plowing a field by hand, less energy in, more energy out. That's what humans do. That is actually deflationary or disinflationary. So the price of stuff should actually get cheaper, right? Like, it takes less labor to make stuff now than it did in the past. So the problem with that is that our debt system is created where we issue debt on assets like houses. And what should happen in a free market is that entrepreneurs come in and drop the price of building a house down to very, very minimal amounts. What would happen if that actually was allowed to occur is that your debt that you've taken out on your house would get into negative equity because you took your debt out on a house that was a price. Let's call it $1 million, and you now have a mortgage on that. Well, what should happen in a free market is that the price of that house actually should go down in value as a free market proliferates. People invent ways to build houses for less money. There is competition, and it drives the house of that price down. But if we all have debt and mortgages based on the value of that house, the house going down would create negative equity, which would create a short, sharp sell-off and disinflation in everything as everyone sells their house and the price falls down and all of our assets go down in value. And then we have this huge deflationary bust and we have social unrest and civil war, right? Because that just can't be allowed to happen. So what we have in a debt-based system is disinflationary forces like technology, manufacturing, forcing the price of everything down. That's actually a good thing, right? Like, who if you were buying your first house, would you be annoyed if the price went down each year? Would you say, this is so wrong, I can't buy my house, it's getting cheaper and cheaper. Food's getting cheaper. What's wrong with the economy? Right? All of the stuff I want to buy, like clothing and TVs, is getting cheaper. Oh no. Disinflation is good, but the problem is that we've created an IOU system, a debt-based system on top of these assets, which we have to actually keep their price higher. Otherwise, we have this huge deflationary bust and civil unrest. And so the only way that we can manage that is by printing currency units to optically raise the dollar price of these assets. And that means that everyone keeps on the hamster wheel. Now, this debt right here, a lot of people are saying this is awful and this is crazy and we need to stop this. No, you can't stop this. This has to keep happening. Because since 2000, what has been the kind of overriding growth factor of the economy? It's technology and the internet. Well, what is technology and the internet? It's disinflationary. It's reducing the price of communication and commerce, driving prices down. Amazon isn't popular because its prices are higher than what came before. Its prices are lower. It's dropping the prices, which is disinflationary, which is creating disinflation within the economy. But on a debt-based system, you cannot have disinflation. So what do you need more of? You need more debt in order to optically raise the prices of assets. This is a byproduct of massive disinflationary forces in technology. And that's not going to stop because now we're inventing AI. We're literally inventing intelligence. Intelligence is being created right now. And so is that inflationary or disinflationary? Disinflationary because the amount of labor and energy that we're going to have to spend per unit of output created is about to crash. If that crashes, disinflation comes into the economy. What do you need in a debt-based system? You need to create more debt and you need to print more currency units to optically raise the price of the remaining assets in the society. This is a byproduct of human innovation. And unfortunately, this is a byproduct of trying to price human innovation in the wrong thing. The measuring stick of fiat currency is broken. Unfortunately, more has to be created, more currency has to be printed, and that is the wrong way to price human innovation. So we have an inflationary system. This will only get worse, and it's a byproduct of human innovation, and AI is going to make it even worse. This is the VNQ, which is a US REIT index, real estate investment trust. So this has real estate, has commercial real estate. I think it has some data center real estate in here as well. So as you can see here, in dollar terms, so you've got the VNQ. So if you invest in this, it's an investable asset. You just buy this, and obviously you want to make some dollar gains. We can see here that since 2005, this was the crash, of course, in 2008. Since then, it's not really going up in value that much, right? Now, we know that property is a good investment. It protects your purchasing power versus dollars. And so everyone's, obviously pushed into buying property. You can see that if we go back before the crash and we just take a kind of price gain, it's up about 40%, right? So if you're invested in property before the crash, you have the crash, they print loads of money, this goes up. So you're about 40% up over 20 years, 40% in 20 years. Not really a great return, is it? That return becomes worse after you realize that the monetary base, this is global M2, is up 150%. Now, these aren't that accurate either. It's actually central banks' balance sheets are up much more than that. So what does this show us? It shows us actually that property is not really a good investment, right? But what they've done is they've optically raised the price of that property by printing currency units. And we have to do that because otherwise disinflationary forces force the dollar price of that asset down. That's actually the natural state of things, is that the free market, if there was a free market, there is no free market in the world, but if there was a free market, the price of property should actually go down as we become more adept at building it and maintaining it with less labor. And so what's happened here is that more currency units have to be smashed into the market in order to just keep optically the dollar price of this real estate up. What happens when you price property in the only free market asset around, which is crypto? Yet to be heavily regulated, very volatile, but it's a free market asset and it's fixed in supply, unlike gold, which is not fixed in supply, unlike property, which is not fixed in supply, apart from monopolistic centers called cities where you have incredible regulation that prevents building at any pace. So a free market asset that is genuinely fixed in supply. This is VNQ, this real estate index, measured in Bitcoin. More accurately, I should inverse this because what we're doing is measuring the value of property in Bitcoin. So this is maybe a little bit unfair because obviously property is a very mature asset and Bitcoin is very young, and so you would expect it to have a lot of growth initially. But look, this is property valued in a free market scarce asset. And so Bitcoin is more accurately pricing in central bank balance sheet expansion, currency unit expansion, much better than a real estate index. And so this gives you an idea of the difference between assets which really shouldn't go up in value, like property, right? It should actually get cheaper so that it should be abundant, right? But there are obviously, like I said, within cities, there are supply and demand curves because people want to be in the city, but you can see what's happening. The city is becoming too expensive because they're printing too many currency units and our purchasing power is going down. And so what happens? We invent ways of making our lives better, which is technology, so that we don't have to live in cities anymore. We can communicate online, we can go on Zoom calls. And all technology is humans trying to figure out a way to make their lives better. And all of these currency units are forcing optically prices up. But if you actually accurately price that in a real money, which cannot be controlled or debased at all and is yet to have a lot of regulation, this is what happens. Property is essentially a currency derivative at this point, right? Because you only buy property with debt. So it's a currency derivative. And so they have to print currency units to keep the price of that up. But what about assets? Things that actually produce and grow at a rate? Because Bitcoin sounds great, but if it's not growing at a pace of other desirable assets, then it's not really worth putting in your portfolio, right? Like it's good to have it as maybe some diversification. And actually, Bitcoin has been the best performing asset and best risk-adjusted asset over the last 15 years. But, there are other ways to gain returns as well, right? So the QQQs is an investment in the only part of the economy that's growing at or above that currency unit debasement, right? Which is it's basically a monopoly, a tech monopoly, who can, what the tech monopoly is in the States is all human innovation just gets sucked up into like these 5 companies because they are a monopoly. They have all the money, they have all the cash flows. And so any good idea just gets sucked right up into those businesses. Those businesses are really not tech companies. They're really just, investment conglomerates, right? So they're money managers. They have all the money, they have all the cash flow, and any good idea just gets sucked up into the business units of those companies now. So they're just a huge investment conglomerate oligopoly. That's great. Invest in it, right? Good news. You can invest in it. It's called the NASDAQ index. Why Bitcoin? Only Bitcoin if it actually outperforms that. Well, it has been. This is Bitcoin valued in the NASDAQ index, and it's insane. So it's very young here. So it's kind of difficult because it's maturing as an asset, but actually on a logarithmic scale, Bitcoin is still outperforming that huge monopoly of money and investment and entrepreneurship and invention. So Bitcoin is outperforming that. We are actually not at an all-time high yet in the QQQ. You can see that here we're about, 25% off an all-time high in the QQQ. There's no point measuring Bitcoin in dollars. Yeah, it's $70,000, it's irrelevant. You should measure Bitcoin in other desirable assets. And if it outperforms then it's something to put into your portfolio, right? Because everything's going to outperform dollars because they're just creating all these units with the specific purpose of pushing up asset prices. So everything valued in dollars or other fiat currency is going to go up. But you want to value Bitcoin in other desirable assets. So this is versus the QQQ. It seems like it's going to continue doing this and outperforming. This is Bitcoin against DBC, which is a commodity index. It's a wide-ranging commodity index. I think there's like copper, zinc, soybeans, wheat, other things, right? Something that we actually need to buy on a daily basis. So what is wealth? It's the ability to buy more stuff over time, or at least the same amount of stuff. So we work, we produce output, we get money in return, and that money is only good to exchange for other goods and services later on. That's investing. So when you can't work anymore, you have savings. Now you can't save in the dollar or other fiat currencies because they're creating more units all the time, specifically with the intent of taking all of your wealth away and putting it into assets that optically raise the price. They can't do that with Bitcoin. So can Bitcoin buy more stuff in the future? And if it can't, don't buy it. If it can, then it's a good investment. This is Bitcoin versus stuff that you're going to need, like food, energy, right? That's stuff you're going to need when you retire. And again, it's an exponential curve to the upside. But yeah, over time it's slowing, but it's a big outperformance. So Bitcoin is helping us gain wealth, which is purchasing power of stuff that we want to buy. And again, we are not quite an all-time high here, maybe 20% off. But you can see we've got the halving. Bitcoin supply gets cut in half, new supply gets cut in half, right? And so we're in a kind of uptick here. So Bitcoin against stuff that you need to stay alive is buying more of it. Bitcoin against other conglomerates and technology companies is doing pretty well. So it's outperforming these, which is obviously something that is desirable as an asset to invest in. This is Bitcoin's risk-adjusted returns. If you're an actual investor, you have to invest through at least 2 cycles before even thinking about moving or changing that investment at all. So at least 2 cycles, which would be 8 years. You want the risk-adjusted return, which is, it goes like this, But if the percentage returns over an investment time horizon, so at least 8 years or more, as long as the yearly return is better than other assets, then it's risk adjusted going to outperform them. The risk adjusted performance is coming down as the asset matures because each growth phase is smaller in percentage terms. But the risk adjusted return is still higher than most other assets, including gold, stocks, bonds. You can see they're all not very good. Bitcoin outperforms them. So on every metric, Bitcoin logically has to be included in an investment portfolio. Central banks control everything short term, especially the Fed and its ally central banks. The Fed controls the amount of dollars, the price for those dollars through interest rates, and even liquidity at other central banks through swap lines. If you're an ally of the Fed, you can just swap your currency for the dollar liquidity, great. Because they have to always make sure that they're pumping up asset prices of assets that should be falling. So we know that the central bank over time actually wants the price of assets to go up. And they're going to do anything to do that, to make that happen, which is printing money or dropping interest rates. Price stability means they want to steal your money by 10% a year. If the money stealing gets way too much and people start realizing and they're like, wait, prices are going up, inflation's really high, then they're going to have to pretend that they draw things down again. And remember, all they have to do to draw things down is just stop. And then natural deflation will occur. The fiat system can't do that. It needs prices up, which is why we have economic cycles of debt refinancing, low interest rates, and then inflation occurs. They have to pretend like they have to draw it down again, which it should do, but they can't have it drawn down too much because then everyone's debt becomes unpayable. So that's why we get these cycles. Listen to what the central bank has to say. Right now, they're, I wouldn't say dovish, but they're not hawkish anymore, right? They've gone peak hawkishness. They're now in that phase where they are looking to cut interest rates a little bit, maybe print some money. China's printing money. Europe will be doing so. Maybe the US does or not. We have to wait and see. But it doesn't really matter. Currency units are increasing right now, and the market is looking forward over the next year and saying it looks like currency units are going to increase, and this scarce asset is being priced in the currency units that are about to increase in amount. So what happens to the price? So listen to the Fed. They're going into an easing cycle. And of course, when the Fed wants to draw that down as well, they can do, which is the next bear market. So we are not there yet. We've got a long way to go, maybe halfway there in terms of this central bank cycle. And so I think things are looking pretty bullish for the short term, ultra short term. Mid-term, you're going to get another drawdown. But ultra long term, you cannot store value in a currency where the currency units are being printed over and over again. So you have to be in desirable assets, whether that's the stock market. Property doesn't really outperform the currency debasement. Bitcoin has done and will continue to do so for the near future, in my opinion. The next 10, 15 years is still really the early growth phase for Bitcoin. If you want to know more about that, check the Crypto Investor course. Lots of videos and updates come for free in there, and the Bybit deposit bonus down in the description. I'm James, it's my cheers for watching, and I'll see you in the next one.